Good evening. This is Duane Lowry for the DPP Grain Desk on Sunday, March 25th, with the Sunday night outlook. First of all, let's talk about weather. The weather forecasts today are pretty much in line with the overall theme that we've seen for the last few days, and looks like a generally favorable Midwest and Plains weather outlook over the next couple of weeks. The one change that would be noted in today's forecast versus the last couple of weeks, there's a little bit of a more of a cooler tone to the forecast than we've had recently, but not a threatening type of temperature outlook. The Midwest will be relatively dry this week. The Plains will be relatively dry this week. Next week there'll be a return of some moisture. Overall conditions point to a generally favorable spring planting outlook and early growth development outlook for the Midwest and the Plains. So I don't see anything that would label weather as bullish tonight. You can label it a non-event if you want, but at the present time, conditions are favorable or acceptable, and you'd have to consider it a slightly negative influence or a neutral influence, but certainly not a bullish influence. Price action Friday going away provided some encouragement to wheat, or some recovery to wheat over the last 2 days. Soybeans performed well on Friday. Not a big surprise from the sharp weakness they experienced earlier in the week. The price action there has been very choppy. Talked about on Tuesday about the possibility of retesting last week's highs, and that's what we did here on Friday. That being said, short-term technical conditions really are not conducive to building new upward momentum. I don't think there's anybody looking to establish new longs in beans here or in any other market as far as that is concerned in front of Friday's USDA reports. So the technical conditions might give way to some weakening again in the beans. Fundamental focus is all on Friday's USDA stocks and acreage data. I don't think there's anything else of interest going to influence traders fundamentally. Wheat market has a bearish fundamental backdrop, and it has had for months, and it looks like it's going to continue to have that for months ahead, at least going into the harvest season, until we get some sort of a major weather threat in the northern hemisphere, which currently does not exist. Global supplies are large. U.S. supplies are large. There's absolutely no threat there. Wheat continues to be priced extremely cheap, historically cheap versus corn. You're going to continue to maximize wheat feeding into and through probably the new crop wheat harvest. The change in that will come about probably by corn, not by something that wheat does, and it'll come about because the U.S. 2012 corn crop is large enough to significantly increase carryout and move the wheat-corn relationships to a more notable level, or more historically normal level. And I think that the important thing to realize there is it's not going to be a rallying wheat market that accomplishes that. It'll come about because corn gets itself priced more historically in a relationship with wheat, and if wheat were to theoretically be unchanged, that implies corn would break fairly significantly. So the realignment of that price relationship is going to occur because the U.S. has a good corn crop and allows corn prices to go down. That relationship will not change because wheat suddenly finds new bullish reasons to be $1 higher than where it is right now. As far as outside markets here for tonight's trade, I don't see much for news, weekend developments. The outside markets, I think, have got an overall downtrending, trend-changing type of theme depending on which market you're looking at. And I think there's a turn to the downside has either begun in some markets like gold. It's in the process of turning in a market like crude oil, and I'm not sure where that leaves the stock market. The dollar index, the U.S. dollar, has strengthened over the last several weeks and appears to have the right type of sponsorship to build an uptrend in that over the next several months. So that's going to provide a backdrop of a negative influence on commodities in general. And I think there's ideas that the U.S. interest rates are going to begin to go up before late 2014. Not sure when, but there's basically a move in the commodity world to move to other investments other than general commodities. So I think that's your backdrop theme there. So I don't think you're looking at a week where outside markets provide support. You might be looking at a week that outside markets have little influence on the grain trade, but if there is any influence, it'll probably be in an eroding outside market tone as the week evolves. As far as the grains themselves for tonight, all focuses on Friday's USDA report. I have no idea what the reports are going to be. Nobody else has any idea what the reports will be either. But I do know this: there's been a general perception for months that we are going to have large acreage in 2012, and I'm talking about large total acreage. And it appears as we get into the spring season that we're not likely to have flooded acres in hardly any region, so we're not going to lose acreage due to prevent plant or flooded acreage or anything of that nature. So you're looking at maximum opportunity based on acres planted. What the mix will be exactly, who knows? You know, the questions that did the recent rally in beans cause people to maybe back away from a few corn acres and put a few more into beans? You know, I don't know. Just talking to producers, I think they're pretty much set on what they were thinking for corn and bean acreage split. You're going to have a early spring that always tends to favor additional corn acres. So I think when you look at the acreage report here, it's going to be extremely difficult to get a bullish acreage figure. The surprise would be that total acreage will be better than people expect, and even though maybe beans get a few more acres, it may not be a significant, at the expense of a significant amount of corn acres. The other thing to keep in mind as we unfold into a favorable spring planting situation, people will begin ratcheting up their trendline yield projections for 2012, and they'll begin to talk about, historically such and such percentage above trend line, and all of a sudden that creates a 170 or even higher acreage figure or yield figure. I'm not trying to embrace that type of rationale. I'm just saying that that's typically how it unfolds. So if you get a favorable spring planting season, the rhetoric on the bear side is only going to get worse. So Friday's reports are basically the last chance for any type of new bullish input. I think the likelihood of getting that is extremely low. Producers need to continue to look at their own operation, their risk management, that they're going to handle opportunities ahead or risks ahead. This is not, as I've said for weeks, if not months, this is not the same market structure that you've had in recent years. You're dealing with a situation that a normal trendline yield will double carryout, will produce corn carryout well in excess of pipeline supplies, completely change the fundamental backdrop, and I think that's a very significant thing to ponder. Now, maybe new crop prices aren't the greatest, or maybe what you'd like to see, but if you go back and look at this time frame in previous years, these are pretty good offering prices to be in the season. And while they're not the best prices that you could have had, you could have sold new crop 12 corn sometime during July, August, September of last year, and certainly been higher than where they are now. You could have sold it in October, November, been higher. You could have sold it in January and been higher. But in relationship to what we're dealing with for downside risk, new crop corn prices may still be 50 cents, 75 cents, even $1 better than what they might be come harvest time. If we have a normal season or a good growing season, it's possible they could be worse. So I think you need to evaluate your crop insurance program that you chose, how much forward sales you already have on the books, but don't underestimate how much risk is at hand here. I think it's very, very significant. As far as beans are concerned, I find that much more difficult to assess. Number one, sometime in the next marketing year, the market is going to have to entice more acreage, whether that's in the U.S. or South America. The world needs to expand soybean acreage. If the U.S. has a good corn crop, we can easily shift 4 million acres of corn to soybeans, produce a unchanged carryout for 2013 in corn, and have added 4 million acres to beans without hurting the corn balance sheet at all. South America is, I'm sure, going to expand acreage, and the prices will have to continue to provide incentive to do so, but current bean crop prices easily provide large incentive for expansion in South America. So I'm not sure how much additional upside is left here in the bean market. I'm guessing not very much, even with those longer term supportive features. So even beans, I think, have every reason to be on the farmer's agenda to protect downside risk there. Um, and I think that the bottom line here is producers need to realize this is a different year than we've had recently. We've got situations on the horizon that make it very plausible to have a very plentiful, if not abundant, supply situation by harvest time, and there's a lot of downside risk. If you're holding old crop corn inventory, remember you're dealing with a situation here where you're going to have a favorable spring and early spring. You're going to bring new crop supplies into old crop positions. Maybe it'll be a while before the old crop market tips over in relationship to new crop values. That's an understandable statement. But it is not important how long it takes for it to happen. The important thing is to realize you've had a price ceiling in place for corn market since October. That price ceiling remains in place, and suddenly with Friday's close, you're 30 cents off of where you were a week ago. And you're not that far from the bottom side of a parameter over the last 2 or 3 months of a trading range. And the trade has been very bullish corn, been long corn. There's been liquidation certainly last week, but there is a threat of additional liquidation pressures, and there's a very real threat of a building of short positions in the corn market if we get a favorable spring start to the growing season because of the outlook for new crop supplies. And I think that holding old crop inventory here has extremely limited upside potential for a reward opportunity, so to speak, and extreme amount of downside risk. And I'm not sure that this is a good time or a good year to take that risk. So for tonight, look for pretty much unchanged values, maybe a trade on both sides, but I think there's going to continue to be a weaker bias and a difficult time trying to build upon Friday's gains. For the DPP Grain Desk, this has been Duane Lowry. Thank you.